Dollar cost averaging, your strategy to invest wisely and successfully by life success. Introduction. In the journey toward financial freedom, investing emerges as a critical pathway, not just to grow wealth but also to safeguard against inflation's eroding effects. Yet, the prospect of investing can seem daunting, fraught with volatility and the fear of making costly mistakes. Here, we introduce a strategy renowned for its simplicity and effectiveness: dollar cost averaging DCA. This book is your guide to understanding and implementing DCA, a method that not only demystifies investing but also empowers you to take action with confidence and clarity. Chapter 1. The Foundations of Dollar Cost Averaging. Imagine embarking on a voyage across the vast ocean of the stock market. The waters are unpredictable, with days of calm seas and sudden, tumultuous storms. Herein lies the allure and challenge of investing. This chapter serves as your compass, guiding you through one of the most effective strategies for navigating this voyage: dollar cost averaging DCA. By breaking down the complexities of investing into manageable, consistent actions, DCA demystifies the process and provides a clear path forward. Let's delve into the origins, principles, and compelling reasons why DCA is an essential strategy for investors aiming for long-term success. The origins of dollar cost averaging. Dollar cost averaging isn't a new concept. It's rooted in the age-old wisdom of moderation and consistency. The idea originated in the early 20th century as a method for individuals to invest in the stock market without trying to time their entry and exit points. It was a strategy designed for the everyday investor, allowing them to participate in the potential growth of the markets without the stress of predicting its short-term movements. The principle behind DCA is straightforward. By investing a fixed amount of money at regular intervals, you purchase more shares when prices are low and fewer shares when prices are high. Over time, this can average out the cost of your investments, potentially reducing the risk and impact of volatility on your portfolio. The fundamental principles of DCA. At its core, DCA is built on two main principles: discipline and long-term perspective. It encourages investors to set aside emotions and stick to a predefined investment schedule, regardless of market conditions. This disciplined approach helps avoid the common pitfall of emotional investing, such as panic selling during downturns or greed-driven buying in surges. A key aspect of DCA's success is its focus on the long term. By consistently investing over time, you're less affected by short-term market fluctuations and can benefit from the potential long-term growth of your investments. This principle aligns with the concept of compounding, where the returns on your investments generate their own returns, thereby accelerating the growth of your portfolio. Why DCA stands out. DCA's appeal lies in its simplicity and accessibility. You don't need a large sum of money to start. You can begin with small, regular investments. This makes DCA an ideal strategy for beginners and those who may not have substantial capital to invest in a lump sum. Moreover, DCA offers psychological comfort. The stock market is inherently volatile, and its fluctuations can be a source of anxiety for many investors. By adhering to a DCA strategy, you mitigate the stress of trying to time the market perfectly, which is a daunting task even for seasoned investors. The regularity of investing a fixed amount can also foster a habit of saving and investing, furthering financial discipline and literacy. Real-world application and success stories. Consider the story of Sarah, a teacher who began her investment journey with a modest monthly investment in a diversified mutual fund. Despite initial reservations and market fluctuations, her disciplined approach paid off. Over the years, her portfolio grew steadily, illustrating the power of DCA in building wealth over time. Another example is John, who started investing in an index fund with regular monthly contributions. When the market dipped, his investments bought more shares at lower prices, and when the market recovered, the value of his portfolio surged. John's experience underscores how DCA can turn market volatility into an opportunity rather than a setback. Dollar cost averaging is more than just an investment strategy. It's a philosophy that emphasizes patience, discipline, and a long-term outlook. By understanding its origins, principles, and practical applications, you're equipped with a strategy that simplifies investing and can lead to significant growth over time. As you continue your investment journey, let DCA be your steady guide through the ever-changing landscape of the stock market. Remember, it's not about timing the market, but time in the market that contributes to investment success. With DCA, you're well on your way to navigating the complexities of investing with confidence and clarity. Chapter 2. The Psychology Behind DCA. Embarking on the investment journey is akin to setting sail on the open sea, guided by stars and the compass of your financial goals. Yet, the voyage is not just about navigating the physical elements, it's also about mastering the internal storms, the fears, doubts, and impulses that every investor faces. This chapter delves into the psychological underpinnings of dollar-cost averaging DCA and how this strategy serves as a beacon, guiding investors through the emotional tumult of the stock market with a steady hand. Understanding investor psychology. The stock market is not just a reflection of economic conditions, it's also a mirror of human psychology. Emotions play a significant role in investment decisions, often leading to reactionary choices that diverge from one's strategic goals. Fear and greed, in particular, are powerful drivers that can cloud judgment. When the market plummets, fear can provoke panic selling, locking in losses. Conversely, when the market soars, greed can prompt speculative buying, exposing investors to heightened risk. DCA offers a countermeasure to these emotional pitfalls by embedding a systematic approach to investing. This method encourages consistency over speculation, helping investors maintain their course through market ups and downs. By investing a fixed amount regularly, the emotional weight of each decision is lessened, fostering a more rational and disciplined investment process. The benefits of emotional detachment. One of the most compelling aspects of DCA is its ability to detach emotions from investing. By committing to a regular investment schedule, you effectively automate the decision-making process, which can minimize the temptation to react impulsively to market fluctuations. This detachment is crucial for long-term investment success, as it aligns actions with strategic planning rather than short-term emotional responses. Consider the analogy of a gardener who plants seeds without fretting daily about their growth. Just as the gardener trusts in the process and allows time and nature to do their work, investors employing DCA trust in the power of consistent action and the long-term potential of their investments. This emotional detachment not only reduces stress but also enhances the ability to think clearly and make informed decisions. Real-life implications of DCA on investor behavior. Real-life examples abound of investors who have benefited from the emotional stability provided by DCA. Take, for instance, Emily, who began her investment journey with apprehension, worried about making the wrong move at the wrong time. By adopting a DCA strategy, Emily found comfort in the routine of regular contributions, which helped her stay committed to her investment plan despite market volatility. Over time, not only did her portfolio grow, but her confidence as an investor did as well. Another example is Michael, a seasoned investor who experienced significant losses during a market downturn due to impulsive trading. Switching to a DCA approach, Michael learned to appreciate the value of patience and the reduction in stress from not having to predict market movements. This shift not only stabilized his investments, but also restored his enjoyment of the investment process. As we conclude this exploration of the psychological dimensions of DCA, it's clear that the strategy is more than a set of actions, it's a mindset. By fostering discipline, reducing emotional turbulence, and promoting a long-term perspective, DCA equips investors with a psychological fortress against the vicissitudes of the market. This chapter has illuminated how, by understanding and applying DCA, you can navigate the emotional waves of investing with grace and confidence, steering your portfolio toward the shores of financial success with a calm and steady hand. Chapter 3. How to implement DCA in your investment strategy. Imagine you're preparing for a marathon, not by sprinting full speed on day one, but by training consistently, increasing your stamina over time. Investing, much like preparing for a marathon, is not about quick wins, it's about endurance, consistency, and strategy. This chapter is your training plan for implementing dollar-cost averaging DCA into your investment strategy, transforming the abstract concept into concrete action steps. Here, we unravel the specifics of starting your DCA journey, making each step clear and actionable, ensuring that you're not just ready to start, but prepared to persist and succeed. Setting your DCA objectives. Before diving into DCA, it's crucial to clarify your investment objectives. Are you saving for retirement, a down payment on a home, or perhaps your child's education? Understanding your goals will influence how you structure your DCA strategy, including the choice of assets, the amount you invest, and the frequency of your investments. Imagine you're charting a course across the ocean. Your final destination will determine your route, just as your investment objectives will shape your DCA strategy. Be specific about your goals, time frame, and risk tolerance, as these factors are the compass that will guide your investment journey. Choosing the right assets. The next step is selecting the right assets for your DCA strategy. Diverse options exist, from individual stocks and bonds to mutual funds and exchange-traded funds (ETFs). The key is to choose assets that align with your investment objectives and risk tolerance. Consider the analogy of packing for a journey. Just as you would choose items that are essential and appropriate for your destination, you should select investment assets that are suitable for your financial goals and the investment climate. For many, broad market ETFs or diversified mutual funds are a good start, offering exposure to a wide array of assets which can help mitigate risk. Determining your investment amount and frequency. Deciding on the amount and frequency of your investments is akin to setting a pace for your marathon training. It's about finding a balance that's sustainable and aligned with your financial situation. A common approach is to invest a fixed amount monthly, but the key is consistency, not the amount itself. To implement this, first, assess your budget to determine how much you can comfortably afford to invest regularly without compromising your essential expenses. Whether it's $50 or $500 per month, the act of consistent investing is more important than the amount. This disciplined approach helps build your investment habit, ensuring you're in the race for the long haul. Automating your DCA strategy. Automation is the equivalent of putting your investment journey on cruise control. Most online brokerage accounts allow you to set up automatic transfers and investments, making it easier to stick to your DCA plan without having to manually make each investment. Think of automation as your co-pilot, ensuring you stay on course even when you're occupied with other aspects of your life. By automating your investments, you remove the temptation to skip a contribution or try to time the market, reinforcing the discipline that DCA instills. Monitoring and adjusting your strategy. While DCA is a relatively hands-off strategy, periodic monitoring and adjustments are essential. This doesn't mean reacting to every market fluctuation, but reviewing your portfolio annually or biannually to ensure it aligns with your objectives, especially if your financial situation or goals change. Imagine navigating a ship. Periodic course corrections are necessary to reach your destination due to changing winds and currents. Similarly, adjusting your DCA strategy ensures that you remain aligned with your financial goals, adapting to life changes and market conditions as needed. Implementing dollar-cost averaging into your investment strategy is like embarking on a long-distance journey, one that requires preparation, discipline, and consistency. By setting clear objectives, choosing the right assets, determining your investment amount and frequency, automating your contributions, and monitoring your progress, you're not just investing money, you're investing in your future. This chapter has laid out the map for your DCA journey. Now it's time to take the first step, with the confidence that you're on a path to financial growth and success. Remember, the journey of 1,000 miles begins with a single step, and your investment journey starts with your first consistent contribution. Chapter 4: DCA and the Path to Financial Freedom. Imagine you're embarking on an expedition to climb a great mountain. The journey is long, the path is sometimes steep, and the weather can change unexpectedly. However, with the right strategy, every step brings you closer to the summit. In the realm of financial planning, dollar-cost averaging DCA is akin to this steady ascent, a disciplined approach that can guide you towards the peak of financial freedom. This chapter explores how DCA integrates into the broader landscape of financial planning, highlighting its role in retirement savings, funding major life events, and legacy building, all while illustrating real-life success stories that bring these concepts to life. DCA as a foundation for retirement planning. Retirement planning is about ensuring you have the resources to live comfortably in your later years, a goal that requires foresight and consistent effort. DCA offers a systematic way to build your retirement nest egg, allowing you to contribute regularly to your retirement accounts, such as 401ks or IRAs. The beauty of DCA in retirement planning lies in its simplicity and the power of compounding returns over time. For example, consider the story of Alex, who started contributing a fixed portion of his income to his 401k every month, beginning in his early 30s. Despite the market's ups and downs, Alex's consistent investments paid off, growing significantly by the time he reached retirement age, thanks to the average cost effect and the magic of compounding. Financing major life events. Life is full of significant milestones: buying a home, funding a child's education, or starting a business. DCA can be a strategic tool in saving for these events. By investing a fixed amount regularly in a diversified portfolio, you can grow your savings steadily over time, reducing the financial stress when these big moments arrive. Take the case of Sophia and Raj, a couple who dreamed of buying their first home. By adopting a DCA approach to their savings, investing a fixed amount into a low-cost index fund every month, they were able to build their down payment fund. When the market dipped, their regular contributions bought more shares, and when it rose, they were already positioned for growth. Creating a legacy. Beyond personal financial goals, DCA can also play a role in legacy planning. By steadily growing your wealth, you can create a financial legacy for your loved ones or contribute to causes close to your heart. DCA's disciplined approach means that over time, you're likely to amass a portfolio that can have a meaningful impact beyond your lifetime. For instance, consider Elena, who dedicated a portion of her monthly investments to a fund earmarked for her grandchildren's education. Through consistent DCA contributions, she was able to ensure that her legacy would provide for their future, demonstrating how strategic investing can translate into generational support. DCA success stories. Real-life stories abound of individuals who have achieved financial freedom through DCA. These narratives highlight not only the financial benefits of DCA, but also the peace of mind and sense of achievement that comes with seeing a long-term plan come to fruition. Whether it's reaching retirement with confidence, celebrating the purchase of a family home, or securing a child's educational future, the success stories underscore the transformative power of DCA in personal financial planning. As we conclude this chapter, it's clear that DCA is more than just an investment strategy. It's a cornerstone of a thoughtful approach to financial planning. Whether your goals are near or far on the horizon, incorporating DCA into your financial strategy can help you navigate the journey with confidence. Just as every step on a mountain trek contributes to reaching the summit, every consistent investment you make moves you closer to your financial goals. Start your DCA journey today and step by step, watch as your financial dreams become attainable realities, securing not only your future, but also the future of those you care about. Chapter 5. Advanced DCA Strategies. Picture yourself as a skilled sailor who has mastered the art of navigating calm seas. Now you're ready to tackle more challenging waters, enhancing your skills and strategies to ensure a successful voyage regardless of the conditions. This chapter is about elevating your dollar-cost averaging DCA journey from the basics to advanced techniques, designed to optimize your investment strategy for even greater success. Here, we'll explore the nuanced aspects of DCA, including tax considerations, portfolio rebalancing, and how to complement DCA with other investment approaches. By deepening your understanding and application of DCA, you're setting sail towards uncharted territories with confidence and expertise. Optimizing for tax efficiency. Taxes can significantly impact your investment returns, making tax efficiency a critical component of any advanced DCA strategy. Consider the placement of assets across tax-advantaged accounts like Roth IRAs, traditional IRAs, and 401ks, as well as taxable accounts. Understanding the tax implications of your investments can help you decide where to allocate different types of assets to minimize your tax liability over time. For example, high-dividend stocks or interest-bearing assets might be better suited for tax-advantaged accounts, where their growth won't be subject to taxes until withdrawal, or, in the case of Roth accounts, not at all. This strategic placement can enhance the overall efficiency of your DCA strategy, allowing your investments to grow more robustly. Incorporating portfolio rebalancing. Portfolio rebalancing is a technique that involves periodically adjusting the allocation of assets in your portfolio to maintain a desired level of risk. As markets fluctuate, the value of different investments will change, potentially skewing your portfolio away from your target allocation. By rebalancing, you ensure that your investment strategy remains aligned with your risk tolerance and financial goals. Implementing rebalancing within a DCA framework can involve reallocating funds from overperforming assets to underperforming ones during your regular investment intervals. This not only maintains your desired asset allocation, but also embodies the principle of buying low and selling high, further optimizing your investment returns. Integrating DCA with other investment strategies. While DCA is a powerful strategy on its own, integrating it with other investment approaches can provide a more comprehensive investment plan. For instance, combining DCA with value investing principles involves regularly investing in undervalued assets that you believe have long-term potential. This combination can leverage the benefits of DCA while also aiming for higher returns by focusing on assets with strong fundamentals that are currently priced below their intrinsic value. Another approach could be to mix DCA with a sector rotation strategy, where you systematically move investments into sectors that are expected to perform well in the current economic cycle. This tactic requires more market knowledge and active management, but can potentially enhance returns and reduce risk in your DCA plan. Real-world applications and success stories. Consider the story of Maya, who applied an advanced DCA strategy by focusing on tax efficiency and incorporating rebalancing into her investment routine. By thoughtfully placing her assets in tax-advantaged accounts and regularly rebalancing her portfolio, Maya was able to navigate through market volatility efficiently, optimizing her investment growth and minimizing tax impacts. Similarly, Alex's story highlights the integration of DCA with a value investing approach. By diligently investing a fixed amount into undervalued stocks with strong fundamentals, Alex maximized the potential of his DCA strategy, achieving significant returns as those assets appreciated over time. As we conclude this journey through advanced DCA strategies, it's clear that the path to mastering your investment strategy is both an art and a science. By optimizing for tax efficiency, incorporating portfolio rebalancing, and integrating DCA with other investment philosophies, you elevate your investment approach, navigating through the complexities of the market with finesse and strategy. Just as a seasoned sailor uses their knowledge and skill to face the open sea with confidence, you too can harness the power of advanced DCA strategies to achieve your financial goals and sail towards a prosperous future. Chapter 6. Overcoming Challenges and Common Misconceptions. Imagine navigating a dense forest where every turn reveals new challenges and the path ahead is not always clear. This journey mirrors the experience of many investors who encounter obstacles and misconceptions that can cloud their decision-making process. This chapter serves as your guide through this financial wilderness, addressing common challenges and debunking myths associated with dollar-cost averaging DCA. By equipping you with knowledge and strategies to overcome these hurdles, we aim to clear the path toward a more informed and confident investment journey. Navigating market volatility. Market volatility is an inevitable part of investing, often causing unease among investors. However, DCA provides a methodical approach to mitigate the impact of market fluctuations. By investing a fixed amount regularly, you're less likely to be swayed by short-term volatility. This consistent investment strategy allows you to buy more shares when prices are low and fewer when prices are high, potentially reducing the average cost per share over time. Despite this, some investors worry that DCA might lead them to miss out on higher returns during bull markets. It's important to remember that DCA is designed for risk management and long-term growth, not for maximizing short-term gains. By staying the course, you can smooth out the effects of volatility and aim for steady growth in your portfolio. Debunking the lump sum investment myth. A common misconception is that investing a lump sum immediately is always superior to DCA. While historical data suggests that lump sum investing has outperformed DCA in certain scenarios, this comparison overlooks the psychological and practical aspects of investing. For many investors, the lump sum approach is not viable due to the lack of available capital or the risk tolerance to invest a large sum at once. DCA is particularly beneficial for those who earn and save over time. It provides a disciplined framework for investing that aligns with regular income streams, making it a more practical and less stressful approach for the average investor. Moreover, DCA can offer protection against the regret and financial impact of investing a lump sum right before a market downturn. Overcoming the fear of missing out FOMO. In an era of rapid information flow and sensationalized investment stories, investors often experience the fear of missing out FOMO on potential gains. This can lead to impulsive decisions, such as abandoning a well-thought-out DCA strategy in pursuit of speculative investments. It's crucial to recognize that successful investing is not about catching every market wave, but about consistent growth over time. Focusing on your long-term financial goals and maintaining discipline in your DCA strategy can help mitigate FOMO. Remember, investing is a marathon, not a sprint. By resisting the urge to chase short-term trends, you're more likely to achieve sustainable growth and reach your financial objectives. Real-life challenges and how to overcome them. Consider the story of Lena, who started her DCA journey with enthusiasm, but soon found herself second-guessing her strategy during a market rally. She watched as others seemingly made quick gains while her portfolio grew more modestly. However, by reminding herself of her long-term goals and the benefits of DCA, Lena stayed the course and ultimately saw her investments grow steadily, reinforcing the value of patience and consistency. Similarly, Tom faced the challenge of maintaining his DCA strategy during a significant market downturn. Despite feeling anxious as he saw his portfolio's value decline, Tom continued his regular investments, which allowed him to purchase more shares at lower prices. When the market eventually recovered, Tom's portfolio benefited significantly from the lower average cost per share he achieved during the downturn. As we conclude this exploration of the challenges and misconceptions surrounding DCA, it's clear that informed and disciplined investing is akin to navigating through a complex landscape with a reliable map and compass. By understanding the nuances of market volatility, the comparison between DCA and lump sum investing, and the psychological traps like FOMO, you're better equipped to stay focused on your long-term investment journey. Remember, the path to financial success is seldom straight and often requires perseverance, adaptability, and a clear-eyed view of the myths and realities of investing. With DCA as your chosen strategy, you are well prepared to chart a course toward achieving your financial goals, armed with the knowledge and confidence to overcome the challenges that lie ahead. Conclusion. As we draw the curtains on this voyage through the realms of dollar-cost averaging DCA, we find ourselves at a juncture where the path behind us is as illuminating as the path ahead. This journey, etched with the wisdom of consistency, discipline, and foresight, has not merely been about navigating the financial markets. It has been a deeper exploration of our relationship with time, money, and the very essence of perseverance. Throughout this odyssey, DCA has emerged not just as a strategy, but as a metaphor for life's broader challenges and triumphs. Like the steady rhythm of waves against the shore, DCA teaches us the power of persistence, the virtue of patience, and the wisdom of looking beyond the horizon of immediate gratification to the vast expanse of future possibilities. This book has aimed to be a companion on your journey toward financial freedom and personal growth. By embracing the principles of DCA, you are not just committing to a method of investment. You are embracing a philosophy that values steady progress over fleeting successes, that finds strength in resilience, and that builds a foundation strong enough to support not only your dreams, but the dreams of those who will walk the path after you. As you stand on the threshold of tomorrow, armed with the knowledge and insights gained, remember that the greatest investment you can make is in yourself. The principles of DCA, woven into the fabric of your daily life, can transform not only your financial future, but also the legacy you choose to create. Let the conclusion of this book not be an end, but a beginning, a stepping stone to a future where the seeds of disciplined investment bloom into a garden of abundance and fulfillment. May the journey of DCA inspire you to navigate the uncertainties of life with confidence, to make choices that resonate with the core of who you are, and to build a future where your financial goals and personal aspirations live in harmony. In the grand narrative of your life, let this chapter on dollar cost averaging be a reminder that the most profound victories are often won not by those who seek to capture the fleeting winds of fortune, but by those who, with quiet determination, set their sails to catch the enduring currents of progress and possibility. Forge ahead with the knowledge that every small, consistent action is a step toward the realization of your dreams. The path to financial freedom and beyond is yours to tread, with the timeless strategy of DCA lighting the way. Here, at the journey's end, we find not a conclusion but a horizon brimming with potential, a testament to the enduring power of investing not just in the market, but in ourselves.